AI anxiety has replaced AI mania in just a matter of weeks. What assumptions underpin the new wave of AI doomsday predictions? Are these assumptions consistent with economic reality? And most importantly, what should you be doing with your money right now? Before I continue, I want to tell you about my book, Merry-Go-Round Broke Down, co-written with Marguerite Chenard, that will be published in the United States on March 31st. Merry-Go-Round Broke Down is a novel about globalization. Set in 9 countries and spanning over 20 years, it is an exploration of the butterfly effect of globalization. We chose to write a novel rather than another policy book to make this important issue accessible to a wider audience. Globalization has brought both good and bad, but it will be a mistake to throw the baby out with the bathwater. After 4 years of sharing my insights about the world with you, I now invite you to support my mission in bringing this important debate about globalization to the general public. The book is available for pre-order on US Amazon, Barnes & Nobles, and other major US booksellers. Just follow the link below. I truly appreciate it. AI has gone from miracle cure to existential threat with remarkable speed. A growing chorus of AI doomsayers has gained attention by portraying artificial intelligence as a destabilizing force rather than a productivity breakthrough. The widely circulated Citrini research report last week is the starkest expression of this fear. Framed as a what-if narrative looking back from mid-2028, it is presented by its authors as a scenario rather than a forecast. Even so, the severity of the scenario has sparked unusually anxious conversations across markets, with software stocks and Indian IT stocks particularly hard hit after the report came out. To assess the Citrini report, it is useful to break it down into 5 key assumptions. The first is that AI will soon become vastly more productive and dramatically cheaper than human labor. The report famously suggests that a Claude agent can do the work of a $180,000 a year product manager for $200 a month. From this, it follows that a large share of white-collar workers, including software developers, analysts, consultants, and other high-income professionals, will lose their jobs. The second assumption is that large-scale layoffs will place a serious drag on economic growth. As payrolls sink and wage income falls, household spending is assumed to contract sharply. Because the job losses are concentrated among relatively high-income earners who account for a disproportionate share of consumption, the report envisages a major negative shock to aggregate demand. The third assumption is that slowing growth and weaker demand by compressing corporate profit margins will prompt firms to accelerate layoffs and adopt AI even more aggressively to cut costs. This dynamics creates a self-reinforcing negative feedback loop between employment, demand, and automation. The fourth assumption is that the income generated by AI-related productivity gains will become highly concentrated in capital owners and a small number of AI-dominant firms. The report further assumes that these gains will largely remain on corporate balance sheets rather than being spent, invested, or redistributed, leaving no meaningful offset to the loss of household income and consumption. The final assumption the report makes is that governments will be unable to respond proactively to this vicious circle. In the report's scenario, the feedback loop is allowed to run unchecked, leading to rising mortgage defaults, tighter credit conditions, falling asset prices, and a negative wealth effect that pushes the economy into a deeper recession and ultimately systemic collapse. Behind every prediction is its assumptions. How valid are the 5 assumptions behind Citrini's doomsday scenario? Let me tell you which one I agree with and which one I do not. Will AI soon become vastly more productive and dramatically cheaper than human labor? Anthropic just released a new version of Claude Code earlier this week. It is not an overstatement to call it a game changer. Earlier AI tools mostly generated outputs, text, code snippets, summaries. Claude Code crosses a critical threshold. AI agents can now read entire code bases and execute repeated, self-correcting workflows coding, testing, and debugging without continuous human supervision. Claude Code also introduces sub-agents, allowing tasks to be decomposed and executed in parallel. Rather than relying on a single linear workflow, a primary agent can delegate discrete subtasks such as refactoring, testing, documentation, or dependency analysis to specialized sub-agents, then integrate their outputs. In this respect, Claude Code begins to replicate not just individual developers, but team-level workflows. I'm told by developer friends that this architecture closely resembles how real software teams operate. The implication is that this will compress development cycles and reduce coordination cost. There's little doubt that these advances will dramatically lower the cost of producing and maintaining software. Even so, I do not share Citrini's view that AI will replace all or even most software as a service businesses. For most large corporations, the appeal of SaaS lies precisely in not having to build and manage sprawling in-house IT operations. I struggle to see many CEOs voluntarily taking on the burdens of maintaining mission-critical software, securing sensitive data against cyber attacks, and navigating an increasingly complex web of regulatory and compliance requirements simply because AI tools make software cheaper to write. Nevertheless, I think a lot of software engineers will lose their jobs over the next 3 years. The United States alone employs roughly 4.4 million software engineers, accounting for about 2% of total employment. If 20 to 25% of them get made redundant over 3 years, it will represent an annual job loss of 300,000 people a year. 300,000 a year sounds like a big number, but according to the Challenger reports, over 150,000 job cuts were announced by the tech sector in 2025, a 15% increase from 2024. If the pace of adjustment remains gradual, the economic impact will be more micro than macro. While there are many other jobs that are likely to be impacted by AI, I don't see massive AI-related layoffs on the horizon. This is because most non-software work has features that sharply limit AI substitution. Jobs that require tacit knowledge, trust, and accountability, not to mention interface with physical reality, should be pretty safe. AI will augment the productivity of people in these jobs, but will not replace them easily. At least not without artificial general intelligence becoming a reality. Nobody knows when AGI is coming out, but the consensus is that not before the end of this decade. This means we have plenty of time before we have to worry about it. I would describe myself as a heavy AI user, even though I don't write any codes. For my purposes, editing and summarizing information, the difference between ChatGPT 4.5 and ChatGPT 5.2 is marginal. I don't think I'm alone in sensing that generative AI is beginning to plateau. That perception helps explain why corporate adoption of AI has remained largely stagnant over the past year. A lot of researchers are looking for evidence of productivity impact from AI adoption. So far, the evidence is weak. Even the jump in US labor productivity in 2025 looks less like an AI miracle and more like the delayed cleanup from pandemic-era overhiring combined with the shift in demand from low productivity sectors like leisure and hospitality into higher productivity ones. The US economy faces plenty of downside risk over the next 3 years. Not least the possibility that AI bubble burst, my central scenario, as you know. But unlike the analysts at Citrini Research, I do not believe mass AI-driven layoffs will be the trigger. My biggest problem with the Citrini report is the assumption that income generated by AI-related productivity gains will become highly concentrated in capital owners and a small number of AI-dominant firms. In several previous videos over the past year, I've explained why I think this is very unlikely to be the case. In my view, AI simply does not lend itself to a winner-takes-all outcome. There are now many large language models with broadly similar capabilities. Moreover, distillation techniques allow these capabilities to be replicated at a fraction of the time and cost required to develop frontier models. What's more, free AI is getting better and better. And as I explained 2 weeks ago, OpenAI's decision to show ads on the free version of ChatGPT will likely force Google to make the AI mode in Google search even better in order to protect its digital revenue that accounts for 75% of its overall revenue. With intensifying competition among large language models, including Chinese ones, I struggle to see OpenAI or even Anthropic turning a profit anytime soon, let alone becoming beneficiaries of concentrated aggregate income at the economy level. Competition among chip designers is also heating up. NVIDIA just reported record revenue and profit, but AMD, Google, Amazon, Microsoft have all developed their own AI chips, and so have Alibaba and Baidu in China. There's no way that NVIDIA can hold on to its 80 to 90% market share and high profit margin for very long. More recently, the memory chip makers have seen a surge in the prices of the high memory bandwidth chips. But the capacity bottleneck behind the price surge should be easing already by the end of this year, as companies from Samsung to Micron ramp up capacity. Micron just announced that it will be investing $200 billion in building new fabs and R&D. Longer term, Chinese memory chip makers like CXMT will also be forces to reckon with. TSMC has been the big winner of AI so far, facing little competition in advanced AI chip production. But we can count on Donald Trump to do everything possible to prevent TSMC from further consolidating its dominance. Trump this week repeated his accusation that Taiwan stole the US chip business. Citrini's research might think differently, but I'm not too worried about a massive income transfer from American workers to TSMC. The same logic applies to ASML, a Dutch company of course. Aside from ASML, other semiconductor manufacturing equipment makers are likely to face intensifying competition from Chinese firms over the next 3 years, as Beijing has made this sector a strategic priority. As AI chips and models become cheaper, any barriers to entry enjoyed by the hyperscalers will erode over time. The Doomsday Scenario in the Citrini report is predicated on the assumption of a massive income transfer from US households to AI companies. I just don't see this happening. If anything, I think the risk is a commoditization of AI over the next few years that will sharply lower its return on investment. AGI could change that, but it will be premature to base any forecast on it. The Citrini report is misleading in more than one way. I strongly disagree with many of the key assumptions behind its conclusion. Even if it turns out that AI becomes vastly more productive than human workers, I think the macroeconomic outcome is likely very different than what the authors of the report have in mind. AI and robotics hold out the promise of an age of surplus, where abundance and not scarcity becomes the defining economic constraint. In that scenario, work becomes optional, prices and interest rates collapse towards zero, and the only limiting factor is physical commodities. Whether society can manage that transition is a separate question, but that is more likely than the Citrini report scenario of systemic economic collapse. With all that said, I am not more optimistic than the Citrini folks. They are pessimistic because they fear AI will become too good. I'm pessimistic because I think AI will not be good enough. If it's not good enough, or it does not become good enough soon enough, I think we will see a bursting of the AI bubble and a sharp slowdown in AI capex spending. That would, of course, send the US economy into a tailspin. This is why I remain bearish on the AI trade and think the US yield curve is not steep enough. Thank you for listening.